the cartels has a limited war chest. So don't buy into the story that the shorts have to cover of their COMEX position, etc. They own the printing machine, like Elon Musk talked about. He identified, I think, 17 machines, but I'm sure there are a few more that's hidden under the closet of some people.
The magic money machine.
Yeah, those people have unlimited war chest to be going.
You're watching Capital Cosm. My name is Danny. It is January 15th, 2026. And my guest today is the CEO of Tech Vanadium, CTV on the TXV. It's John Lee. John, thank you so much for coming back on the show, my friend.
Good to be back, Danny. Happy New Year.
Happy New Year. And man, has it been a wild new year, especially for metals. And pretty much commodities as a whole. Like everything is breaking out, John. Silver, gold, lithium, rare earths, fluorspar,
platinum,
yes. Oil. So it seems like gold really led the charge over the last couple of years. Silver has woken up in the last several months. And now all these other commodities, copper as well, all of them, they're all starting to wake up too. And so the question I often get is, silver's already broken out to $90+. Is it still, can I still get in? Is it still early? I think so, because if you look at this thing from a broad perspective, this is a 40+ year cup and handle. It's taken 40 years to form. And this isn't just going to be a one and done thing within a couple of weeks. This is part of a larger trend. You're seeing it in the bond market. Bonds are starting to hit a bear market. We've been in a 40-year plus bond market, 40-year plus bull market for bonds. Yeah. And silver and gold commodities have pretty much been in a downtrend with those interest rates. Now that interest rates are breaking out, investors are looking for other places to put their money outside of bonds. What are they looking at? Gold, silver, other commodity producers too. So I want to kick this off with you. Let's talk about silver. Everyone wants to talk about silver here. We're sitting at $90 plus right now. But I'm going to pose the same question to you. What's going on here with silver? What's the broader theme that's playing out today? Clearly, there's industrial demand with silver, but something seems to be breaking with the silver market. What's your take here?
Yeah, it's never, I've come on your program before and many other channels. It's never the industrial demand that drives the market. It's always the speculative demand. If you look at price of oil during COVID, it actually went to negative, just to show that how much the investment demand can sway price actions either way. I am 100% concurring with you about your sort of macro theme. This is not driven silver specific. I mean, now you look at some of the worst fundamentals in metals, such as nickel, with the supply from Indonesia, platinum, with this of lack of industrial demand. So just the entire commodity complex is staging a big rally, and the reason for that, Danny, as I mentioned, it's not industrial or metal specific. It's really got to do with the macro theme. If you look at the 1970s, gold went from $30 an ounce to 800 in the span of a decade. So that was a 25x gain. And that was the result of the money printing that started in the 50s and eventually led to the sever of the gold window in 1971, 1972, 1973. Similarly, even though there is not a fixing of the gold price per se, but the price is heavily managed. The bull market for gold started in year 2000 when Gordon Brown, the Bank of England, dropped its last batch of gold at 250. So if you apply the same analogy, back in 70s it was 25x from 30 to 800. If you multiply 250, which is the bottom, which is a year 2000, by 25, you're gonna reach a target of 6,250. Gold's action has been extremely strong in the last 3 years. I speculate what happened is that, as I said, as you mentioned, gold's leading the charge. it's as it did in the 70s. And a lot of the bystanders and speculators were waiting for gold to correct. And what happened was when gold went from 1,800 to 3,500 in a hurry, and when gold didn't, when the investors noticed and realized that gold is not going back down below 3,500, that was about 6 months ago. That's when silver started breaking out the $35 handle. So I went on a couple of programs, and I even tweeted in on my X back in July of 2025, say that it's the best time to buy silver, as there was a clear rotation of money from gold into silver, amongst other metals. And sure enough, in the span of less than 6 months, silver has more than doubled from 40 to 90, and platinum has almost doubled as well from about 1,500 to now trading at about 2,500. And then you see a breakout of copper to its all-time high. And so that's a testament of what's happening in terms of the macro theme, and that is the money that's being the savers, all the mom and pops institutions, central banks, the well-to-dos, the billionaires, the centibillionaires. They're realizing now that all the fiat is coming out of the bottle. There's not any specific reason per se, but it's just the accumulation of the last 30 years, 40 years, since 1980, 45 years, that people have been accumulating fiat in an ultra-low inflationary environment in the last 45 years. And now the game is coming to roost. And to answer your question on silver, right now the gold to silver ratio is at 50. So it's actually near the bottom range of this ratio, historically speaking. So silver compared to gold, relative to gold speaking, is fairly valued at this point. In fact, it's probably a little bit overvalued with this historical average ratio of 70. However, the ratio of gold to silver, the pendulum swing usually to the extreme. So gold to silver ratio was at 100 less than a year ago, and now it's at the 50. Usually the pendulum swing usually to the other way quite severely. So I think the investor, for me, the key indicator I look at is gold going to continue its uptrend, because gold had just broken out its $4,300 level. Now it's trading at 4,600. So gold has to hold and continue its rally and breakout above 4,600. And we have to see in the next 3 months to make sure that gold is not staging a fake breakout. So if gold continues its trajectories above 4,600 on its way to 6,200, then silver could be, let's just say, at a $6,000 gold, at a $50 gold to silver ratio, you'll be looking at $120 silver. But if you look at the a typical blow off for silver, and that's when gold to silver ratio at a 30, and if you would pack a $6,000 gold at a
Hey John, you there?
$30 gold to silver ratio, then you can. So my target has been revised from $75 to $80, which is being reached, to now $120 to $200, depending on where gold is headed.
Well, I've got to give it to you. The last time you and I spoke was sometime in September, and you said that a move was imminent in silver within 6 months, and it happened. It actually happened before. It happened within the 6 month window that you said it was going to happen. You said like something along the lines of $100 silver within 6 months. We haven't hit $100, but we're getting close to it, and we're about 3 months into your prediction, 4 months, and I could definitely see us hitting $100 silver in the next 2 months. It's definitely in the realm of possibility. So I've got to give it to you there. I mean, your predictions have been pretty solid so far. And you also mentioned the interest rates, the bond market. This is a chart of the 10-year yield, the U.S. 10-year yield. And as you can tell, we've been in a declining interest rate environment, a bond bull market since the 1980s. Last time we were in a bear market was in the 40s all the way up until the 80s. Now, what's interesting is that if you overlay the price of silver on top of it, you'll notice that the price of silver and white pretty much tracks interest rates. As interest rates go up, price of silver goes up. When interest rates went down, the nominal price of silver went sideways. And that's priced in U.S. dollars. Obviously, in real terms, the price went down in silver. And now that we've broken out of this lower interest rate environment since 2022, lo and behold, silver's breaking out at the same time. So this is a very powerful correlation here. And from the looks of this chart,
just like the 70s,
yeah.
like the 70s. We're going back to 1970, going back to 70s. And it was Paul Volcker that put the genie back in the bottle with the 15% plus interest rates. I am not stating that we're going to see a 15% mortgage rate, but we're definitely going to see double digit. This is we're still at a very early stage of a breakout of the interest rates or the crashing of a bond market. And this is, again, all by design to meet the 2030 agenda of own nothing and be happy. And the way to do that is to widen the two-tier, to widen to wipe out the middle class and have this two-tier system, the king and the slave. And the way to do that is to be jacking up the interest rates. So by design, I mean, Danny, do you remember back in 2011, 2013, 2014, when oil was $140 and interest rate was like 2%, like 1%? And the Fed was saying that, oh, you know, any inflation was transitory. You don't have to worry about it. And any whiff of a banking crisis or North Korea testing a missile and then immediately emergency cut 50 basis points. Now we have two wars going on in Ukraine, in Hugo Chavez, and yet interest rates are still, and oil is at $60. You would have thought that interest rate would be 1%, and yet we're 5%, at 4.5% for the 30-year. So, and then the same these Fed governors of Kalikari of Minnesota or Wisconsin was ultra easing, and now he's leading the charge, being a hawk on interest rates. So it's the same actors, but the script is being different scripts being fed. And I came on the program about 3 years ago, just right after COVID, when the yield curve was inverted, when the 10-year and the 30-year yields was lower than the 2-year. I said that is one of the trades of the century, to be betting on a widening spread of interest rate spread. And sure enough, now we have the yield curve has to be normalized, meaning that the 30-year rates are higher than the 10-year, which is higher than the 2-year. But we're going to see a breakout of the interest rates, and I'm extremely bearish of bonds because gold and commodities and silver, and they are clearly indicating that there's inflation. And now I'm in Asia, I'm noticing inflation are running quite rampant. You could get some of the fancier places in Bangkok, you'd be paying $50 for a cocktail, and there's no relief in sight. So and subsequently, Oracle, of which I'm a director, are moving into shorting some of the treasuries, which is a great play for a bit of a hedging against silver. Because if silver continues to go up, that means the interest rate is going to continue to go down. But the start of the interest rate decline has only started. The top of the treasuries was in 2021 in the COVID era, and it had a rapid ascent to 3% for the 10-year. But now the 10-year is going to break out of a 4% range to be getting to about 7 to 8% range. So which means the 30-year could be passing 10%, and your mortgage could be well over the double digit. So for these other adjustable variable mortgages, I highly recommend you lock in on that 30-year right now before it's too late, Penny.
Yeah, it's definitely happening in commodities too. Like you said, all the signals are there. So here's a chart of the CRB, the Thomson Reuters Commodity Index, and it looks like we're just coiling up here. You could technically draw a cup here and then a handle here. And, you could forecast a move up to, I don't know, somewhere around here in the commodities index, which would be a doubling commodity prices based on this cup and handle pattern that we've seen here so far. But I would think that this is kind of an undershoot considering all of the money printing that's coming down the line. President Trump wants a dove to replace Jerome Powell, who he's giving a hard time with now with the investigation from the DOJ. So it seems like this is the time for commodities to shine, and with that is going to come another huge wave of inflation. You look at this spike here in commodities that we saw in 2020 all the way up to 2022. That was the initial spike of inflation that we saw 2021 to 2023. So it looks like we may be heading into another stream of inflation.
I am not so bearish even on the short-term interest rates. If Jerome Powell were to be replaced and then the short-term cut rates will be cut once or twice, I think the Trump administration will be met with rage and in the market, meaning that it will just be breaking out like crazy, and that the rate action will have to be reversed to be going up instead of going down. So, but there's one caveat I want to put out there, which is the dollar. I am very, very bearish of the euro. I was just in Italy for a conference 2 months ago. That continent is if you think the dollar, borrowing from Doug Casey, is at least you can go to the U.S. government to claim something, but the euro is I owe you to whom? To nobody, and so I'm very bearish of the euro fundamentally. And which means that the dollar is now staging a rally above the 200-day moving average. Typically, gold will move in the opposite direction of the dollar, and that's why I want to caution a bit to be watching closely of the action of gold's action, which is going to be a foretelling sign of a potential temporary top or even a long-term top in place, because there's a lot of good things going for the dollar. It's taken over Venezuela in its oil reserves. And it's also sort of taking euro with euro waning down. The dollar is reasserting itself as the reserve currency. So there's a lot of good things going for the dollar, meaning the dollar index. And so that could be at the expense of gold's action, at least temporarily. So I can see dollar go back to 100 from currently around 93. That's 7% up. And gold has to stay above this $4,400 breakout level for the commodity market to continue. And then the other thing to watch out for, Danny, is I've been watching the market for 25 years, a lot longer than I like to admit. I'm 51. I got in the market at year 2000 after I semi-retired from the Silicon Valley. Is that the cartels has a limited war chest. So don't buy into the story that the shorts have to cover of their COMEX position, etc. They own the printing machine, like Elon Musk talked about. He identified, I think, 17 machines, but I'm sure there are a few more that's hidden under the closet of some people.
The magic money machines.
Yeah, those people have unlimited war chest to be going against you, and oftentimes they would engineer a top. So what they do is they will literally at the closing of New York market at 4 p.m. they would jack out the market. They would just buy the futures market, in droves, and then up till about Hong Kong. So they would climax the market, gold and silver market in Hong Kong at 9 o'clock Hong Kong time, which is 8 p.m. New York, and then so they would jack up that. Maybe you can potentially imagine gold and silver went up from 4 p.m. New York close, and up. Potentially $10 to $20 silver and maybe $300 to $500 gold, and that trend continues to squeeze the short to exhaust the buying at 9 a.m. Hong Kong Open, and about 9:30 Hong Kong Open, then you're going to see start precipitous selling, and as well as check in with the dollar in selling the euro, and that's going to continue nonstop. And then when the New York opens at 9 a.m., it's going to just hammer the market down. So I mean, it's happened a couple of times. It is now their classic signature action to try to tame the silver and gold prices. So you saw this happen a couple of times where silver was driven up until Hong Kong opened, and after Hong Kong opens, then silver started going down. And platinum was also a good tell signs, because sometimes there's still gold and silver buying, but platinum will be down like 7-8% right from the get-go in Hong Kong. So that is something you want to watch out for. That if you see a big rally after market and then and a big whack from the Hong Kong market and a big down on gold is on platinum, and you just want to like your position in the futures for gold and silver. And so that is something you want to watch out for, along with the rising dollar.
I see. So earlier on, we talked about all of these commodities rising to the top, all the cream rising to the top here. And so it begs the question, what commodities right now offer the greatest asymmetry or some of the best asymmetry out there? And I know one that you wanted to talk about was a commodity called fluorspar. For those who don't know, what exactly is fluorspar, and what's the asymmetry on fluorspar? For those that are, we're looking at the silver price; it's at $90+. Gold's at all-time high. Copper just broke at an all-time high. But fluorspar, is that the next big asymmetric bet in the commodity space?
I am not into copper. There's a deceleration in global economies, and the global population is headed towards a collapse, much like Elon Musk talked about. Contrary to popular beliefs, that my beliefs, there's less than 4 billion people on Earth, not 7. And the economies are cooling right now, even though commodity prices are heading up as a result of the investment demand, not so much on the physical demand. Industrial demand. So I'm not a big fan of copper. That's why you see the underperformance of copper relative to gold and silver. And oil is even further laggard, given its vast supply and the electrification moving towards EV from ICEs. So, I mean, we're definitely past the first inning. I would say we're probably in the 4th or the 5th inning. But you don't want to cash out your chips too early because the most gains happen towards the tail end of a bull market. Look at NASDAQ, right, in 1999. Look at silver in 1980. So you don't want to be missing out the train. So I would just say maybe cashing, not be writing 100% of your position. If you got in silver early, you should have made 3 to 5 times of your money from buying metals and from silver miners. But like I said, we are shifting a bit of money towards a bearish of betting against of the treasuries, and also nibbling a bit on some of these latecomers like oil and even nickel. But again, the fundamentals, the physical demand fundamentals, just are not there. You talk about fluorspar a little bit. So fluorspar is gone up already 5 times since the bull market started in 2000. But it's trading at around right now $600 a ton from less than $100 a ton in year 2000. And let me give a bit of a primer on fluorspar. I think we talked about it 6 months ago. Fluorspar is all about energy production, electricity production, and electricity storage. So noted that fluorspar is critical in nuclear enrichment. 6 fluorine atoms are required to be married to a uranium, to levitate it, to gasify it for enrichment, to separate the fissile uranium from the heavy uranium. And it's the fissile uranium that can go through the nuclear reaction process. So fluorspar is required for and that is a major use of application for fluorine, of which fluorspar is the raw material that fluorine is extracted out of. And the other massive use of fluorine in the last decade, and that's the reason China turned into an importer from being an exporter 3 years ago, is energy storage. So every fluorine, there's 6 fluorine is required to be married to a lithium atom, and that is the electrolyte of which the lithium swim back and forth between the cathode and the anode. So everybody talk about lithium and graphite being the anode, and cobalt, nickel, manganese being the cathode, these transition metals. But people don't talk about fluorspar. So it's what I call a Robin to the Batman, and usually sometimes it will have to take a cliff like rare earth for the U.S. market to be realized, and I think we're headed towards that, Danny. And that's why CleanTech, of which I'm the CEO, started on this fluorspar venture a year ago, and now has amassed the largest land holding of fluorspar in the U.S. in the Kentucky, Illinois district, and that's where 95% of the historical production of fluorspar in the U.S. And right now there is no production of fluorspar in the U.S. and we're looking to become one of the largest, or to restart fluorspar operation and production again in the U.S.
Yeah, I was going to say, I mean, how do you play fluorspar? There's not many plays out there. There's obviously your company, ticker symbol CTV on the TXV, and I've got a chart here so people can see. You can clearly see a breakout here from a trend downtrend line, and
yes.
The company's been moving up, and now you're resting on support, potentially getting ready for another launch up higher. What do you make of this current price action on CTV? And what are some of the catalysts that you see driving the price moving forward?
Danny, Cleantech is one of the 2 companies listed on the American exchange that has exposure to fluorspar in America. This Kentucky-Illinois fluorspar belt is around 600 square miles, of which Cleantech controls around 20%. The area that Cleantech controls is already in the size of a Manhattan, with 10 million tons of historical fluorspar resources. Albeit it's not 43101 compliant, but we're working towards that, publishing a updated report, and over 740 drill holes on our properties. So we're very, very confident of that. There is a lot of materials underground in our projects. Unfortunately, there's not a COMEX NYSE exchange for fluorspar, and there's not an ETF that features fluorspar. So you have to be buying company like CTV to get exposure to fluorspar. The October rally is consummate of with other critical minerals like rare earth and germanium, antimony. And now the stock is settled back a bit, and you can see a new basing at around 14-15 cent range, ready for another breakout. The valuation right now is only at around 20 million, of which institutional insiders own close to 50% of the stock. The company has no debt, about $1 million in the bank. And in terms of valuation, our comparable peers in Australia are trading 10 times the valuation. Same are Mongolian fluorspar plays. They are being gobbled up by the Chinese. And these people are paying about $30 to $50 a ton of fluorspar in the ground. So if Cleantech can prove up to 10 million tons of resources in the ground in the months and years to come, this could potentially be a 10-bagger from where we stand, Danny.
Yeah, and it doesn't take much. I mean, this is a $22 million market cap company. The last time we had you on, I believe you were out here at 6 cents, and now that's a 3x from 3 months ago. So the price has already moved quite a bit.
Like I said, it's 20% at the bottom, but it's far, far from the top. Our peers trading at a valuation of 10 times what we trade at today. And secondly, if we want to look at some of the critical minerals, or even silver, for example, when commodities stage a rally, this stock could be a 10-bagger. I mean, look at some of the rare earth companies like NP Materials went from $10 to $70, and the stock had a 10-bagger from the bottom to the top back in October. And now we're meeting and talking to a lot of people that are accumulating the stock. So I don't think it's going to take a whole lot for the company to reassert itself in this rally. And in terms of the major milestones, Danny, the company is first of all looking into getting the story out, much like rare earth. In fact, I think the fundamentals are stronger because China has become an importer of fluorspar, given they're building these batteries like there's no tomorrow to complement their solar production. And so one of the things we're going to be announcing a program in upgrading our resources from historic to 43101 standards, and laying down a path for production in terms of permitting and other requisite studies. And then I want to preface it going back again. Fluorspar is related to energy production and energy storage. But why would we care about energy production and storage? The answer is all about AI. ChatGPT, which is OpenAI, are talking about investing $50 billion in building data centers with the help of the Saudis and SoftBank, the Japanese, and the Trump administration. And Elon Musk is doing the same, as well as with Amazon and Oracle. These data centers, Danny, are not measured in the number of chips. They're measured in gigawatts, which is the amount of power that it consumes. So in a way, they are training these machines like babies, right, to be digesting and gobbling up all the data from your Gmail, from YouTube, from all the data that's ever been published online. So they are building these babies to be training these babies to walk, to talk, to think based on the data that's available. So it consumes immense amount of power. And a modern power plant, which takes 10 years to build, is sized up at a gigawatt. A gigawatt power plant is big. it is the standard largest size of power plant. Like the biggest power plant of Bruce Power in Canada is 4 gigawatts, and that's 30 years in the making. So if the Elon Musk and the Meta and the Amazons and the Zuckerberg and the OpenAI are talking building 50 gigawatts of power, that will require that's the U.S. power consumption, the power demand supply has to come up 30% in the next 5 years. And the only way to do that is solar, which is the largest growth, fastest growth power source, which is renewables now the second largest power supply in the U.S. behind natural gas, ahead of coal and nuclear. And the only way to continue to supply that much power for all these power-hungry data centers is solar to be married with batteries. And that's why the Chinese are building 10 to 20 gigawatts of energy storage every year, and they're running out of fluorspar. So in a way, fluorspar is the way to ride the AI boom. The AI boom is not about chips. The bottlenecks are not about chips. They're not about land. They're all about power.
Yeah. Well, it's trying to. My good friend Chris McIntosh, he says when these commodity bull markets hit, it's like you're trying to kiss all the girls at the same time, but you've got to pick you can only kiss so many girls. So
yes,
fluorspar could be one of those biggest asymmetric bets, and obviously you guys are positioned for it. So I'd like for everyone to get at least put it on their radar screen and consider it. Pull up the charts, look at it for yourself. I mean, we're already up 10% today as I'm recording this, so. Some interesting opportunities lay in the wake here for Clean Tech Vanadium as well as fluorspar. John, thank you so much for coming on the show, my friend. Anything else that you'd like to mention before we take this thing home?
Yeah, first of all, I highly recommend your audience go to cleantechctv.com or go to YouTube, just search Clean Tech Vanadium. We put a lot of educational videos about what fluorspar is about. It's a very fascinating element. And I've done about a dozen plus interviews about this critical minerals. I am very, very bullish. When you are competing with China, China is also looking for fluorspar. We got a big winner here, and I'm very, very bullish of the action. So right now it's a great entry point in terms of the risk to reward ratio. And secondly, I want to talk about there's a lot of bears out there. Remember, there's Robert Prichard about the fifth wave, and Ian Gordon of these guys, and a lot of bearish guys that are predicting imminent crash of the market. But what they're not getting is that the likes of BlackRock and State Street and Fidelity, these institutions are proxies of the power that be, already own 80 to 90% of the equity market. Now they're buying single family homes, farmlands, and they're also venturing out into the Nikkei market and Asia market with their printed currencies. They have a printing machine. So I'm not in the camp of doom and gloom. You don't want to be playing cute and short the market, and you don't want to also be too cute about taking your profit too early, because as I said, the best gains are in the last innings. So Yeah, Danny, I would just caution those people who are bearish in the market. The power that be, through the proxies of State Street and BlackRock and the Vanguard, own around 80% of the market already. So I would see any correction in the market as a buying opportunity. And secondly, to diversify away from gold and silver a bit into something like fluorspar, as gold and silver mining companies had already staged a huge run-up. And then third is I would definitely looking to locking up your mortgages into 30-year fixed rates, as we're going to see a bull market in interest rates. And you're going to see interest a lot higher in the months and years to come, Danny.
All right. Yeah. Well, I mean, you've been fairly spot on with your predictions so far since we've had you on the show, John. So we'll see how things progress. Thank you so much for coming on, my friend. We'll have a link to your website, the Clean Tech Vanadium's website down below, and any other links that you'd like to provide, we'll have those in the description box as well. Thank you so much for coming on. Guys, if you enjoyed this podcast, drop us a like and comment, go, John, go, in the comment section. Let me know your thoughts. Look at the fluorspar. Look at the
Yeah, the internet connection a bit spotty. I recommend your audience go to YouTube, and we have a dozen plus videos about fluorspar. Highly recommend your audience check it out.
Yep. We'll have those. Yeah, check it out, guys, and like the video, comment down below, let me know your thoughts, and subscribe to the channel so you don't miss an episode. And by doing all three, you do help in pushing us in the algorithm. So I would, a little bit does go a long way in this regard. So thank you so much for your time, and I will catch you all next time. Bye.